Right. Good afternoon, everybody. Good afternoon. Right. Today we start a new chapter. That is chapter number 4. The types of risk at financial service institutions. So this chapter is all about risk and its risk management in financial service institutions like bank. Primarily, we are concerned on banks and other financial service institutions. And chapter outcomes, our learning objective of this chapter. This chapter is covered the types of risk facing at financial service institutions. Let us give some an overview on risk management and risk faced by the financial service institutions. Risk, we know, there is an uncertainty. It makes an unfavorable circumstances falling the organization in the unfavorable, unwelcomed uh, situations. It's about uncertainty. There is no sure. There's no certainty. So one of the major objectives of financial institutions managers is to increase the financial institution's return for its owner. No, not only the financial service institutions, all organizations management works toward the maximizing shareholders' wealth, maximizing shareholders' wealth. And there's a theory called risk and return. Uh, so there's a positive relationship between risk and return. So every business entities has its own risk, its own risk. If the entity or if an investor takes uh, willing to get more return, he or she should face high risk. But getting higher risk, it gives not guarantee. There's no guarantee for uh, making higher, end up with higher return. Right? That's an uncertainty. Right. Increased return increased return often come at the cost of increased risk, which comes in many forms. The risk in many forms. So any businesses, when you take any businesses, if the businesses take more risk, they will end up with high return. In other words, to earn high return, the entity should face a high risk. Without facing high risk, enjoying high return is impossible. So there are mainly 10 types of risk faced by financial service institutions. Financial institution, right? So first one, credit risk. Credit risk simply means the banks and other financial institutions provide loan to its customers. Sometimes the borrower, the customer, fails to repay the loan principal and interest. It may happen. It's like a bad debt. It's a credit risk. It's a credit risk. Liquidity risk. To operate the day-to-day operation of the bank or financial institutions, they should keep a certain amount of money in their hand. Due to unexpected withdrawals of large amount of money from the bank, the bank will face a liquidity risk. They does not have enough money to meet the customer's demand. Interest rate risk. The interest rate is fluctuate over time. Sometime interest rate will be higher, sometime it will become lower. So due to this fluctuation in interest rate, the income of the financial service institutions will affect it. Market risk, the market value, the fair value may be changed due to several reasons. The market value of financial assets, market value of the bonds, market value of any derivatives, futures, maybe fluctuates due to several reasons in the market. So in that time, the bank sometimes end up with loss, sometimes they may end up with profit. So that is uh, market risk. Off balance sheet risk. So there are different types of items. Uh, some items can be disclosed in the balance sheet, income statement. So past events, right? So this kind of events called on balance sheet items. On balance sheet items, whatever the items we can find in the balance sheet of an entity, it's called in balance sheet items, in balance sheet activities. Some items cannot be disclosed in the balance sheet of an entity. So for example, uh, there's a court case. There's a court case. If entity win that case, the entity may obtain 1 billion rupees from the opponent. If the company lose the case, lost the case, the company, the entity should pay 5 billion rupees to the opponent. So this kind of things cannot be found in the balance sheet. So this kind of items called off balance sheet. Sometimes companies may promise to its customers to provide some kind of items, future sale agreement, or sometimes they give some letter of credit. The bank certifies about credit worthiness of importer. In such case, the importer not meets the obligations. For that instances, banks should face that kind of risk. So these kind of things we cannot find in the balance sheet of an entity. So this kind of things we call as off balance sheet activities. So due to the off balance sheet activities, there are some kind of risk may arise. So that kind of risk is called as off balance sheet risk. Foreign exchange risk. Foreign exchange risk. So time to time, the foreign exchange rate differs. Sometimes it may increase, sometimes it reduces. A domestic currency may appreciate it or depreciate it. So due to these fluctuations, financial institutions, not only financial institutions, other organizations, those who are dealing with international trade, international portfolio management, they encounter risk. A country or sovereign risk. There are some countries where the government interfere with business activities of companies. So for example, a bank provide a loan to a customer who is living in China, a big amount of money. And after some period of time, the Chinese government restricts on outflow of money from their country. So that time, Sri Lankan banks is unable to collect money from the customer who is living in China. This is not because of the customer has bankrupt, but it is due to the government policy. So that kind of risk arises, called country or sovereign risk. Technological risk, technology. So day by day now new innovations comes into the market. So due to this new introduction, the new technologies may affect the operations of financial institutions. So for example, a bank has installed a digital technology in their system, but due to some reasons they are unable to enjoy the full utilization of that technology investment as they expected. They are unable to control the cost. So at that time the new technological risk arises. Operational risk, it's a business risk. It's a business risk. Due to inefficiency of management of the company, of an entity, some businesses face loss due to overstaff, or due to strikes, or due to sudden uh, things may happen. So it's operational risk. Insolvency risk. So the capital requirement of the bank or the financial institutions is not enough to run their businesses. Capital adequacy is not enough. So that time they face insolvency risk. Now we'll discuss every risk in detail. Credit risk. So as I mentioned, as I explained earlier, credit risk is the risk that the promised cash flows from the loans and securities held by financial institutions may not be paid in full, right? So the bank provide loan to its customers, but the customers fails to repay the loan, or the bank purchase bond from the secondary market, and the bond issuing company, bond issuing entity fails to pay the promised interest and principals on that bond. So this kind of risk called credit risk. The amount given as loan to its customers is unable to recover from them. So it's a credit risk. Financial institutions that make loans or buy bonds with long maturities are relatively more exposed to credit risk, right? When banks or financial institutions give a loan, short-term loan, the chances for credit risk is low, because so they can recover the money within 20 days or 30 days or 60 days or 90 days. The probability of failing to repay the money is low. But in case of 20 years loan, 10 years loan, 15 years loan, uncertainty is uncertain. The future is uncertainty. The future is uncertain. Today, the financial capacity of the borrower may be in the good condition. In 20 years, after 20 years, his conditions is uncertain, right? He may be in the good level, good financial position, or in the very bad financial position. So the longer term loans has a higher risk, credit risk. right? And that's the bank's thrift. Thrift mean the savings and loan association. And insurance companies are more exposed than money market mutual funds and property casualty insurance companies. Many financial clients issued by individuals or corporations have limited, very limited upside. There is a limited chances for growth in return with higher probability, right? Limited chance. So there's a limited chances for growth, limited chances for high growth, and a large downside. Sometime, so sometimes the financial institutions are facing huge risk because of the, the large downside, great fall, downside risk. It's a low probability. A key role of financial institutions involve screening and monitoring loan applicants to ensure only the creditworthy receives loan. So to mitigate this kind of credit risk, what the banks do normally. So when any customer applying for a loan, the bank will study about the customer, the borrower. If the company, if the bank certifies, okay, he has a financial capacity, no issue on that, then the bank will definitely issue the loans. And the government, so the banks are willing to provide loan to government officers because they have a job security. So business people when they apply for a loan, they have to face a lot of difficulties. They want a guarantor, surety, mortgage, sort kind of things because of the credit risk issue. Financial institutions also charge interest rate commensurate with the riskness of the borrower. Right? When a bank, government officers asking for a loan, the bank charges at lower rate. When other people apply for a personal loan, they will charge higher interest rate. Why do the banks charge a higher rate for the individuals or private personal loans? Because of those people are having higher risk than the government officers. The effect of credit risk are evidenced by charge-offs, right? Charge-off means unable to collect money from their customers. The effect of credit risk are evidenced by charge-offs. The bankruptcy law, right? Bankruptcy law makes it more difficult for customers to declare bankruptcy. Now the act, the court systems restricts on the bankruptcy on customers. Financial institutions can diversify away some individual specific credit risk, but not systematic risk. Firm specific risk mean the risk is only affected, associated a particular organization, a particular individual, or particular firm. Firm specific risk is the risk of default for the borrowing firm associated with the specific type of project risk taken by that firm. So there are some kind of risk activities that may affect only a particular organization, not other organization. For example, uh, breakdown of machineries in the company. Assume cement factory. Suddenly, one machine, one motor, a large motor has fired. It's a large risk. The risk is affect only a certain particular firm. Think about COVID-19 pandemic, tsunami, flood. So this kind of risk, this kind of events may affect all the organizations of the country, of the regions. So that kind of risk called systematic risk. Systematic risk. Systematic credit risk is the risk of default associated with general economy-wide or macroeconomic conditions affecting all borrowers. Liquidity risk. Liquidity, the reasonable amount of money required to run day-to-day business. That's called liquidity. So if they don't have enough money to run the business on day-to-day basis, so it's called liquidity risk. Liquidity risk is the risk that a sudden and unexpected increase in liquidity withdrawals may require and financial institutions to liquidate assets in a very short period of time and at lower prices. So now in the banks, there it's normal. So people are deposit the money and people are withdrawing the money. So based on the experience of the bank, they are maintaining a certain amount of money in their hand. Other monies will be used for making loans. Sometimes suddenly large depositor withdraw the money. Say, so normally people are withdrawing 500,000, 10,000, right? 1 million, 20 million, like that. Sometimes people may deposit 1 billion, 5 billion. So if they wanted to withdraw the money in a single day, think about the situation of the bank. Normally the banks do not keep that amount of money in their hand. So if such customer wanted to withdraw the money from the bank, the bank have to make arrangements to repay the money. For that, they have to sell some of their assets to a market price lower than the market. And they have to face additional cost, or they have to, again, the bank have to borrow from another bank or other branches. The day-to-day withdrawals by liquidity holders are generally day-to-day withdrawal by liability holders, depositors, are generally predictable. Usually, large withdrawals by liability holders, deposit holders may create liquidity problems. The cost of purchase and the borrowed fund rises for the financial institutions. Second, supply of purchased or borrowed fund declines. Financial institutions may be forced to sell less liquid assets at fire sale prices, very lower prices. So these are the consequences of liquidity risk. Interest rate risk. Interest rate risk. So for example, now you wanted to get a loan from a bank. Assume that now the bank gives loan at lower rate, say 5%. Annual interest rate 5%. Due to government policy, all the banks have reduced their interest rate due to the pandemic. Now this time you can apply for a loan for about 1 million or 50 million at the rate of 5%. It's a 10 years loan. It's a 10 years loan. And after some month period, again the interest has increased. Now the interest rate is 15%. The new interest rate is 15%. You have taken loan at 10%, at 5% for 10 years. Now interest rate is increased, but you have taken loan at fixed rate, at fixed rate. Then what will happen? So the bank will face difficulties. So due to increase in interest rate, you are unable to get high interest rate. You can't enjoy the benefit of high interest rate because you already given loan at 5% for a long term. And vice versa. During the period of high interest rate, the customer have taken loan for about 15% interest rate. Later, the interest rate has reduced to 5%. Then what will happen? The borrower will take the risk due to he unable to enjoy the benefit of lowering interest rate, lower interest rate. So this is the example for interest rate risk. Asset transformation involves and financial institution issuing secondary securities or liabilities to fund purchase of primary securities or assets. If financial institutions' assets are longer term than liabilities, it faces refinancing risk. Refinancing risk. So, for example, right? So, personal example, right? Personal mean individual example, not thinking about the banks. So, what I have observed several people, especially the government officers, they are getting loan for a lower rate, at a lower rate. They are getting a loan, say 50 billion, right? They are getting loan from the government 50 million rupees, for example, at 5% interest rate for 20 years loan. 20 years loan, right? 20 years loan at 5%, 50 million. Then that loan can be that 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 officer take the money as a loan at 5%, deposit the money in the bank at high interest rate, fixed deposit at 15% interest rate. So what he do? He earn 15% interest from the bank. From that income, the officer pay interest at 5% to the government. He may earn 10% margin profit. So if he say this person take 20 years loan, if he deposit money for 20 years, he will not end up with any problem. But if he take loan for 6 months, but he has deposited fixed deposited for 1 year, he has taken loan for 6 months, the maturity of the loan is 6 months, and when he deposit the money, the agreement was 1 year. It's mismatch. That time he wanted to find the way of getting money to settle the loan in the government. Or vice versa. He has taken 20 years loan, but he has deposited for 1 year or 5 years. And again he wanted to find investment opportunities. So that is called reinvestment risk. He wanted to find places to invest again and again. So the risk, the financing risk. If an financial institution's assets are longer term than its liabilities, it faces refinancing risk. We wanted to find the ways to get the money. The risk that the cost of rolling over or reborrowing fund will rise above the return being earned on some investments. So sometimes the income is lower than the cost incurred to refinance. If financial institutions' assets are shorter term than its liabilities, it faces reinvestment risk. So the risk that the return on fund to be reinvested will fall below the cost of fund. All financial institutions face price risk, a market value risk, right? The risk that the price of security changes when interest rate changes. You might study in financial management, valuation of bond, the par value, coupon rate, interest rate, cost of debt, right? You may find the relationship. When the market interest rate is lower than the coupon rate, so market value of the interest rate, market value of interest rate is lower than the coupon rate, then the price of the bond may increase. Price of the bond may increase. If the market interest rate is higher than the coupon rate, the bonds are not very much attractive. So therefore, the price of the bond may be reduces. So this price risk arises due to the changes in interest rate in the market. The risk that the price of the security change when interest rate changes. Financial institutions can hedge or protect themselves against interest rate risk by matching the maturity of their assets and liability. So they're matching. So if you take 20 years loan, you have to invest in 20 years project. If you take 6 years loan, you have to invest in 6 year, 6 month. If you take 6 month loan, you have to invest in 6 month investment, right? Made a match. So this approach is inconsistent with the asset transformation function. Now we'll look at the market risk. Market risk is the risk incurred in trading assets, especially financial assets and liabilities due to changes in interest rate. For example, bond, right? Liabilities due to changes in interest rate, exchange rate, and other asset prices. So closely related to interest rate and foreign exchange risk. So think about the gold price. Every time it's a market price is changes. So it's due to what? It's due to foreign exchange risk. If our currency is depreciate again and again against US dollar, the price of the gold will increase, right? Ads, ads trading activity, ads trading activity. That is market risk. Is the incremental risk incurred in the incurred by financial institutions in addition to interest rate risk or foreign exchange risk caused by an active trading strategy. Active trading by financial instrument, buy and sell financial instruments. This is trading activities. So financial institutions trading portfolios are differentiated from their investment portfolios on the basis of time horizon and liquidity. So trading assets, liabilities, and derivatives are highly liquid assets. Investment portfolios are relatively illiquid, low liquid assets, and are usually held for longer time period. Think about land. So you cannot make quickly as money. You have to wait for a period of time. Financial assets, some assets are very much tradable. If you purchase equity shares, a well-reputed company in the Colombo Stock Exchange stock market, you can sell quickly as possible. If the company is, if it's a private company shares, it's difficult to find people to sell it. So declines in traditional banking activity. So what's traditional banking activity? Uh, accept deposits and provide loan and earn interest. What are the other ways of earning profit by the banks? Underwriting services, exchange rate services, money transferring services, issue of letter of credit, primary market activities. So in that way, they may earn profit. Decline in traditional banking activity and income at large commercial banks have been offset by increases in trading activities and income. Decline in underwriting and brokerage income at large investment banks have been offset by increases in trading activity income. Actively managed by mutual funds are also expected to market risk. Financial institutions are concerned with fluctuation in the trading account assets and liabilities, value at risk, and daily earning at risk (DER) are the measures used to assess market exposure. Market risk exposure has caused some highly publicized losses. The failure of the 200 years old British Merchant Bank barring in 1995, right? 200 years bank, Merchant Bank has lost in 1995. 7.2 billion, right? $7.2 billion in market risk related loss at Society Generally in 2008. It's a French company. Still it's there, but it faced loss in 2018 due to the financial crisis. Now we move to the off-sheet balance sheet risk. So this risk arises due to off-balance sheet activities. OBS risk is the risk incurred by a financial institution as the result of activities related to contingent assets and liabilities. Contingent assets and liabilities. So the contingent assets and liabilities you couldn't find in their financial statement. For example, future case. If we won the case, we get a 1 billion. If lose, we have to give 1 billion. So it's a contingencies. With this kind of transaction, this kind of predictions, you couldn't find in the balance sheet. Right? It's risk incurred by a financial institution as the result of activities related to contingencies, assets, and liabilities. Off-balance sheet activity can increase financial institutions' interest rate, credit risk, and foreign exchange risk. Off-balance sheet activity could also be used to hedge, right? OBS activities also used to hedge, which means reduce the risk, managing the risk, minimizing the risk. That's called hedge. Financial institutions, interest rate risk, credit risk, and foreign exchange risk. Large commercial banks, in particular, engage in OBS activity on balance sheet assets of all US commercial banks total 10.8 billion, 8 trillion in 2007. You see the amount of off-balance sheet activities. The notional value of OBS items total 180.6 trillion in 2007. You see, on balance asset is 10.8 trillion on balance. You can find this figure in the balance sheet. Here off balance sheet total item how much? 180. Almost more than 10 times of on balance assets. You see the figures, right? In trillion, high 12 zeros. OBS activities can affect the future shape of financial institutions' balance sheet. OBS items become on-balance sheet items only if some future event occurs. So, for example, court cases. A letter of credit, sometimes, not sometimes, many times bank issues letter of credit in case of import. In case of import, if the importer fails to pay the money to the exporter, they will charge from the bank who issue the letter of credit. It's a certification letter of creditworthiness of the importer. A letter of credit is a credit guarantee issued by a financial institution for a fee on which payment is contingent on some future event occurring, most notably default on the agent that purchased the loss, right? Sometimes the importer not pay the money. So that time banks may face risk because bank has give a guarantee. Other examples like letter of credit, what loan commitments by right, loan commitments by bank. In future, the bank promised that to someone else that they wanted to, the bank will give a big amount of loan to a customer, but actually they may not have that amount of money to provide loan, so unable to uh, meet the obligations, honor the obligations. Mortgage servicing contract by saving institutions, mortgages. Position in forward, future, swap, and other derivatives held by almost all large financial institutions. Foreign exchange risk is the risk that exchange rate changes and affect the value of an financial institution's assets and liabilities denominated in foreign currencies. Think about, you may have an amount of US dollar. If the value of dollar increases, you may happy. If the US dollar reduces, you may you may feel sad because what you have a big amount of US dollar in your hand, right? Financial institution can reduce risk through domestic foreign activity or investment diversification locally. Financial institutions expand globally through acquiring foreign firms or opening new branches in foreign countries, investing in foreign financial assets. Return on domestic and foreign direct and portfolio investments are not perfectly correlated. Underlying technologies of various economies differ. Exchange rate change are not perfectly correlated across countries. The net long position. A net long position in a foreign currency involves holding more foreign assets than foreign liabilities. So long position. So we have, for example, we have more US dollars in my hand. So I have long position. I have so US dollar is an assets. So financial institutions loss when foreign currency falls relative to US dollar. So if the US dollar value declines, I may face loss. Financial institutions gain when foreign currency appreciates relatively to the US dollar. The net position in the foreign currency involves holding fewer foreign assets than a foreign liability. So I have to pay some amount of money. So I have to pay US dollar to one of my supplier in US. So I want more to pay. Financial institutions gain when foreign currency falls, depreciates relative to the US dollar, and financial institution losses when foreign currency appreciates relative to US dollar. So think about sterling pound and US dollar. Sterling pound and US dollar. At all the times, these two currencies are fluctuate over time. Now we look at the country specific or the currency. So country or sovereign risk. So some governments is not allowed to forward money to some countries. In Africa, we can observe this kind of countries. We can earn so whatever the amount in that countries, but you can't bring the money to your home country. You have to spend there. You can earn, but you have to spend in such countries, and you can buy goods and items. So in the risk that repayment from foreign borrowers may be interrupted because interference from foreign government. So it differs the credit risk of financial institutions' domestic assets. So it's totally different from credit risk. So with domestic assets, financial institutions usually have some recourse through bankruptcy court. Financial institutions can recap some of their losses when default firms are liquidated or restructured. So if the firm is local firm, if they are unable to pay the money, so at least they can get some amount of money at the time of resolution or liquidation of that company. So foreign corporations may be unable to pay principal and interest even if they would decide to do so, even though if that person willing to give that money, but government not allowed to do so. So foreign government may limit or prohibit the debt prepayment due to foreign currency shortages or adverse political events. Thus, financial institutions claim holder may have little or no recourse to local bankruptcy courts or to an international claims court. So they can't go for any court cases if the customers are in their foreign country. So measuring sovereign risk included analyzing the trade policy of the foreign environment government, the physical stance of foreign government, political government intervention in economy, the foreign government's monetary policy, capital flows and foreign investment, the foreign country's current and expected inflation rates, the structure of the foreign country's financial system, which impact on their sovereign or country specific risk. Technology risk and operational risk are closely related, right? So technology risk is the risk incurred by a financial institution when technological investments do not produce anticipated cost savings. So the entity purchase or the bank purchase a big computer, server computer for their branch. They was expect to earn more profit and it welcomes more customers. But after the installation of that server machine computer, there's no a significant improvement from that purchasing in the company. Technology risk is the risk incurred by the financial institution when the technological investments do not produce anticipated cost savings. The major objective of technological expansions are to allow the financial institutions to exploit potential economics of scale and of economy. So why do companies purchase large machines? To achieve economic of scales, to minimize cost. So lowering operation cost, increasing profit, capturing new markets. So these are the reasons to introducing new technologies, but it is not gives a promised result. Operational risk is the risk that existing technology or support system may malfunction or break down, machine breakdown, or blast in their organization, company, accident in the company. So due to that reasons, it will arise as operational risk, right? The BIS, Bank for International Settlement. Right? Operational risk is a risk that existing technology or support system may malfunction or break down. So BIS, the Bank of International Settlement, Bank for International Settlement, defines operational risk as the risk of loss resulting from inadequate, right? Inadequate or failed internal process, people and system, or from the external events. Insolvency, right? Insolvency, they are meet unable to meet some capital requirement, minimum capital requirement. So insolvency risk is the risk that financial institutions may not have enough capital to offset a sudden decline in the value of its assets relative to its liabilities. Insolvency risk is a consequence or an outcome of one or more of the risk previously described. So we have discussed so many risk: credit risk, market risk, liquidity risk, solvency, sorry, uh, country risk, technology risk, operational risk. So insolvency risk may arise due to that risk. So that kind of risks may impact on the market value of assets. So that time, the financial institution should have enough capitals to recover from that risk. So interest rate, market, credit, off balance sheet, technological, foreign exchange, Sovereign, and or liquidity risk. Generally, the more equity capital to borrowed fund a financial institution has, less insolvency risk it is exposed to. So if the bank is low levered, when compared to borrowing fund, capital equity is higher, then the solvency risk is low. So when borrowed money is higher than the equity, so that time they will face higher chances for insolvency risk. Both regulators and managers focus on capital adequacy as a measure of financial institutions' ability to remain solvent. Other risk and interactions among risk. In reality, all of the previously defined risks are interdependent. Example, liquidity risk can be function of interest rate and the credit risk. When the managers take actions to mitigate one type of risk, they must consider such actions on other risks. Changes in regulatory policy constitute another type of discrete or event-specific risk. So other discrete or event-specific risks include war, revolutions, sudden market collapse, theft, malfeasance, and breach of fiduciary trust. And macroeconomic risk include increased inflation, volatility, and unemployment. So we have an activity, select a bank, select a financial institution in Sri Lanka, and briefly explain each type of risk faced by select institutions with a given example. So it's maybe a home assignment or so home activity. If it's good if you read. And we will discuss about risk management.